Ingersoll Rand, ticker IR on the NYSE. Tracing its roots to 1871, when Simon Ingersoll patented the first steam-powered rock drill and formally merged with the Rand Drill Company in 1905, Ingersoll Rand spent over a century as an industrial diversified conglomerate before a 2020 transformation that created the focused company it is today.
In 2020, Gardner Denver, a KKR-backed compressed air company that had gone public in 2017, merged with the industrial segment of the original Ingersoll Rand under CEO Vicente Reynal. What emerged was a focused industrial technology company with a clear mission: compress air, move fluid, and measure precisely.
Vicente Reynal came from Danaher, where he spent 10 years, then led IDEX Corporation's pumps business before becoming CEO of Gardner Denver. His background is entirely in the Danaher-style operating playbook: continuous improvement, portfolio simplification, and relentless margin extraction.
The 80-20 methodology is the operating engine. Reynal applies it across every acquisition, identifying the 20% of products and customers that generate 80% of profit, cutting the rest, standardizing processes, and raising margins within 18 to 24 months of closing.
The business splits two ways: industrial technologies and services, air compressors, power tools, and industrial equipment at 72% of revenue, and precision and science technologies, medical peristaltic pumps, laboratory liquid handling, and semiconductor pumps at 28%. Total revenue is $7.8 billion.
Adjusted EBITDA margin is 28.2%, up 1.8 percentage points year over year. Adjusted EPS grew 12%. Organic revenue growth is 5.4%, excluding acquisitions. Aftermarket parts and service mix runs approximately 38% of total revenue.
That aftermarket mix is structurally valuable. Every compressed air system sold creates a multi-decade service and parts relationship. The customer does not want to switch because the risk of downtime in a manufacturing environment is too high. Aftermarket revenue is sticky, recurring, and margin accretive.
On the competitive radar, Ingersoll Rand scores 92 on M&A engine strength, the highest of any industrial peer. Roper Technologies comes closest as a serial acquirer, but focuses primarily on software. Illinois Tool Works leads on EBITDA margin with a more mature portfolio.
Reynal has completed over 50 bolt-on acquisitions since 2020, averaging $50 to $500 million in purchase price, each targeting engineering moats in adjacent niches where the 80-20 playbook can unlock 30 to 40% EBITDA margins within 2 years.
The Precision and Science Technologies segment is the higher margin piece. Medical peristaltic pumps for pharmaceutical manufacturing, laboratory fluid handling for drug discovery, and specialty pumps for semiconductor fabs carry 45 to 55% gross margins, far above the industrial compressor core.
The global network spans over 40 countries under more than 40 brand names, with over 500 authorized service centers. 16,000 employees manage the acquisition, integration, and operational transformation agenda across that footprint simultaneously.
Reynal's engineering degree from Valencia, his Wharton MBA, and his decade at Danaher have been applied to 30-plus companies inside Ingersoll Rand over 4 years. The CEO is also the chief integrator. The operating system and the deal pipeline run through the same person.
Vicente Reynal has transformed Ingersoll Rand from a spun-out into a 28% EBITDA margin industrial compounder through 50-plus acquisitions and relentless 80-20 simplification. The playbook works.
The margin expansion toward 30% is the ongoing thesis. As acquisitions add complexity faster than 80-20 can simplify it, investors want to see the margin hold and expand. We dig into the numbers every quarter. Subscribe so you never miss a Charged Alpha deep dive.
Adjusted EPS of 77 cents beat the estimate by 4%. And Ingersoll Rand, which traces its roots to 1871, maintained its full-year guidance despite IT&S organic revenue going negative in Q1.
Revenue hit $1.85 billion, a hair above estimates and up 7.6% year over year. The beat was real but masked by a sharp split between segments.
Industrial technologies and services, the largest segment at 78% of revenue, posted organic growth of negative 1.6%. Precision and Science Technologies grew organically 4.4%.
The central question heading into 2026 was whether IT&S softness was cyclical or structural. This quarter does not close that debate, but management kept guidance and pointed to a backlog up high teens %.
The biggest operational update is the closing of Signup, the latest bolt-on in a deal program that now totals 70-plus acquisitions and $5.4 billion deployed since 2020.
Orders came in at $1.98 billion, up 5% year over year. That order growth is the pipeline signal management needs to support its second-half weighted revenue outlook.
P&ST book-to-bill hit 1.04 times in Q1, meaning the segment is taking in more orders than it ships. That is a leading indicator for continued growth into the back half.
IT&S organic revenue declined 1.6%, but total IT&S revenue still rose 7% when acquisitions are included. The question is whether organic demand inflects before deal math stops compounding.
Management held 2026 guidance unchanged. Revenue growth of 2.5 to 4.5%, adjusted EBITDA of 2.13 to 2.19 billion. A guidance hold after a soft IT&S quarter is a confidence signal.
The backlog, up high teens % since year-end 2024, is the quantitative anchor for second-half confidence. Revenue is phased back-half heavy, and management said Q2 will look similar to Q1.
Section 232 tariff mitigation is working. Roughly 75% of manufacturing is in region, limiting direct tariff exposure. Delayed pricing recovery is expected to flow through second-half contract renewals.
EPS of 77 cents adjusted beat the 74-cent estimate by 4%. GAAP EPS came in at 49 cents, with the gap driven by acquisition-related amortization and stock compensation, standard for a serial acquirer.
Revenue of $1.847 billion beat estimates by 17 million, a 0.9% beat. Year-over-year revenue growth of 7.6% reflects both organic contribution and M&A.
IT&S generated $1.44 billion, up 7% total but down 1.6% organically. IT&S adjusted EBITDA margin came in at 26.7%, down 210 basis points year over year.
P&ST generated $403 million, up 10% total and 4.4% organically. P&ST adjusted EBITDA margin expanded 120 basis points to 30.3%. That segment is accelerating.
Adjusted EBITDA for the full company was $469 million at a 25.4% margin, down from the recent 28% run rate as acquisitions dilute margins ahead of 80/20 simplification.
Gross margin held at 43% for the quarter. GAAP operating margin came in at 15.7%. The adjusted EBITDA margin compression is the number analysts are watching most closely.
Orders of $1.978 billion grew 5% year over year, the most forward-looking number in the release. Orders growth tells you what revenue will look like in 2 to 3 quarters.
Free cash flow was $163 million in Q1, with operating cash flow at $200 million. Capital expenditures ran $37 million. EBITDA to free cash conversion remains healthy.
Share repurchases were $89 million in Q1, with $500 million remaining under the current authorization. Ingersoll Rand returned more capital through buybacks than through its token 8-cent annual dividend.
Net leverage came in at 1.7 times adjusted EBITDA, the same level as year-end 2025. Total liquidity stands at $3.9 billion, giving the deal machine ample fuel for the next acquisition.
Vicente Reynal called Q1 results solid momentum, high single-digit adjusted EPS growth, revenue, and EBITDA meeting internal targets. The framing is measured, neither a victory lap nor a warning shot.
The full-year earnings midpoint of $3.51 per share puts Ingersoll Rand at 23 times forward earnings at the current price. That multiple leaves limited room for a second organic revenue miss.
The balance sheet has $1.3 billion in cash against $4.8 billion in total debt, net debt of $3.67 billion. At 1.7 times EBITDA, leverage is moderate for an active acquirer.
Total liquidity of $3.9 billion keeps the M&A engine running. 70-plus bolt-on deals and $5.4 billion deployed since 2020, averages more than one close per month across 4 years.
The 2026 guidance midpoint implies full-year adjusted EBITDA margin of approximately 28%. Getting from Q1's 25.4% to 28% full year requires meaningful second-half margin recovery, a back-half earnings load.
The forward EPS projection at the guidance midpoint of $3.51 puts Ingersoll Rand at 23 times forward earnings, in the middle of its peer band, with Parker above at 28 times and Dover below at 22.
EV to EBITDA stands at 18.5 times on trailing figures at the guidance midpoint EBITDA of $2.16 billion. Forward EV/EBITDA drops to approximately 15 times, more defensible for the M&A compounder thesis.
The 8-cent annual dividend yields just 0.1%. Ingersoll Rand is not an income story. Buybacks are the real return vehicle. $89 million in Q1 alone, $500 million remaining under authorization.
P&ST runs at 30% EBITDA margins versus IT&S at 26.7%. The mix shift toward P&ST is structurally accretive as that segment grows faster on both organic and acquisition channels.
IT&S margin fell 210 basis points year over year, absorbing recent deals and pricing delays. Management expects pricing recovery to flow through as second-half contract renewals hit.
The aftermarket parts and service mix, approximately 38% of total revenue, provides a recurring revenue floor. Each compressor system sold locks in a service relationship measured in decades.
Overall, Ingersoll Rand's financial health is solid. Free cash flow is strong, leverage is controlled at 1.7 times, and the guidance holds signals management confidence in second-half delivery despite a soft Q1 organic start.
Synomix, the Q1 acquisition, expands the lab automation beachhead inside P&ST. Each bolt-on follows the same pattern. Enter, apply 80-20, expand margins, repeat. That is 70-plus repetitions of the same play.
Capital expenditures of $37 million, just 2% of quarterly revenue, confirm the asset-light nature of the model. Gross investment flows to M&A, not factory build-outs.
Parker Hannifin is running above 25% EBITDA margins on its industrial side in recent quarters. The bar IT&S needs to clear to justify current valuation on organic recovery.
IDEX Corporation carries 44% gross margins and is growing organically at 5.8%, trading at 25 times forward earnings versus Ingersoll Rand at 23. The IDEX premium reflects more consistent organic growth without execution risk.
Dover Corporation grew revenue 10% year over year and trades at 22.6 times forward earnings. Dover is cheaper than Ingersoll Rand on PE, but carries lower gross margins at 36%.
On price to sales, Parker trades at 6.1 times, nearly double Ingersoll Rand's 3.3 times. That gap reflects Parker's more mature, higher-margin aerospace business versus IR's industrial services mix.
Ingersoll Rand sits in the middle of its peer group on both growth and valuation. The premium over Dover reflects the M&A compounding thesis. The discount to Parker reflects lower aerospace exposure and more execution risk.
The clearest peer gap is deal velocity. 70-plus acquisitions in 4 years is categorically different from Parker or Dover's pace. More upside potential, more execution risk.
Roper Technologies, the industrial serial acquirer that pivoted to software, trades at 38 times forward earnings. That is the long-term destination the IR compounding thesis targets, assuming quality of earnings improves.
The central risk, IT&S organic revenue went negative in the company's largest segment. 1 quarter is excusable. 2 consecutive quarters of negative organics would raise questions about structural demand masking by M&A.
IT&S EBITDA margin fell 210 basis points year over year. If tariff pricing pass-through delays into 2027, the full-year EBITDA guidance range faces downward pressure.
The ILC Dover write-down in 2025 is a relevant data point. Not every bolt-on works at the pace Ingersoll Rand runs. More deals means more tail risk on individual execution failures.
Tariff re-escalation is the macro wildcard. In-region manufacturing at 75% limits direct exposure, but new Section 232 action on steel and aluminum hits the compressor manufacturing cost base directly.
Options reflect a recovery play setup. The stock sits 20% below its 52-week high of 100.96. Implied volatility is elevated and put-heavy, consistent with a binary debate on whether second-half organic recovery materializes.
CEO Reynolds sold $30.6 million in shares via a pre-established 10b5-1 plan at a $10.61 exercise price, deeply in-the-money option vesting, not discretionary selling. No open market purchases were made.
Valuation at 23 times forward earnings leaves little buffer. A second consecutive IT&S organic miss in Q2 would shift the market narrative from M&A compounder to cyclical industrial, and that derating would be fast.
14 analysts cover Ingersoll Rand, 9 buy, 5 hold, 0 sell. That is a moderately bullish consensus with no bears, unusual for a stock down 20% from its highs.
The average price target is $94, implying 15.8% upside from current levels. Targets range from 72 to 113, a spread reflecting real disagreement on when IT&S organic recovers.
Citigroup maintains a strong buy, the most bullish rating on the board. The thesis centers on second-half backlog conversion and secular tailwinds in P&ST from life sciences and biopharma reshoring.
Goldman Sachs and Barclays both maintain buy ratings with targets in the $95 to $100 range. Both focus on the 80-20 margin recovery potential once the most recent acquisition wave is integrated.
Stifel holds a hold at roughly current price levels. The concern, paying 23 times forward earnings for zero organic growth in the largest segment, is difficult to underwrite before second-half data arrives.
No analysts changed their rating post-earnings. The consensus read, Q1 was on track, guidance hold was expected, and the next move depends entirely on Q2 IT&S organic data.
A 15.8% analyst consensus premium on a stock down 20% from its high is a forward recovery bet. Q2 IT&S organic growth is the first real test of whether that bet pays.
The bull case starts with orders. A 5% year-over-year order increase across both segments is the forward revenue pipeline. If backlog converts as expected, Q1 organic softness becomes a timing issue, not a trend.
P&ST is the bull inside the bull. Book-to-bill of 1.04 times, 4.4% organic growth, 30% EBITDA margins. The medical and life sciences pump business is accelerating into structural demand.
The 80-20 playbook has worked. Margins expanded from 23% in 2021 to 28% by 2024. Recent dilution from new deals is a timing feature of the model. Margins recover systematically as integration completes.
At 23 times forward earnings with a backlog up high teens %, the stock is not priced for recovery. If second half delivers organic inflection and margins recover toward 28%, the 94 to 100 analyst range is defensible.
The bear case highlights IT&S organic decline of 1.6%. Rivals, including Parker Hannifin, IDEX Corporation, and Dover Corporation, are posting positive total revenue growth. If IT&S organics continue sliding, the compounding thesis faces a credibility test.
If IT&S organic stays negative in Q2, the 2026 EBITDA guidance range faces downside risk, and the 23 times multiple is hard to defend without recovery data.
The ILC Dover impairment in 2025 demonstrated that 80-20 does not work on every deal. 70-plus acquisitions is a large portfolio with tail risk. The next impairment is unlikely, but not zero.
The bear math: organic flat or negative, acquisition dilution holds down margins, and the market stops paying compounder premium. Derating from 23 to 18 times on 351 EPS implies a $63 stock.
Ingersoll Rand delivered a narrow EPS beat and a guidance hold. Free cash flow is strong, the acquisition pipeline is active, and management is signaling second-half confidence. The market needs organic confirmation.
The stock at $81 is 20% below its 52-week high, pricing in IT&S doubt. 14 analysts peg fair value at $94. The gap between them is the Q2 report due in July.
Watch Q2 IT&S organic growth. Management guided it similar to Q1, meaning flat to negative again. A second quarter of negative organics in the largest segment reopens the structural demand question.
Ingersoll Rand has compounded enterprise value more than 8 times over in 4 years. Raynal has earned credibility. Q1 was a test quarter, not a verdict quarter. Q2, IT&S organic data will write the verdict.
That wraps up Ingersoll Rand Q1 2026 on Charged Alpha. Watch IT&S Organic in July.
Before we wrap up, a quick note. Charged Alpha does not provide investment advice. Everything you've heard today is for informational and entertainment purposes only. We are not financial advisors, and nothing in this episode should be taken as a recommendation to buy, sell, or hold any security. Always do your own research and consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street